Welcome to MoneyRx for CRNAs and nurse practitioners. I'm Brett Fellows, certified financial planner. A lot of the expensive surprises in retirement are things that you genuinely cannot see coming, like a drop in the stock market or some type of health scare, or just general unexpected costs. But the surprise that I want to talk about today is different. And for a married nurse with a large pre-tax retirement account balance, well, for you, a surprise is pretty much certain. You can literally see it coming years in advance. And there is a window to do something about it, but that window is only open while both spouses are still alive. So here's what I'm talking about. Whenever the first spouse in a household dies, the survivor's income drops, but her tax bill actually goes up. So same retirement withdrawals, but now with a smaller standard deduction amount on your tax return and much narrower tax brackets filing as a single. And lastly, a new Medicare surcharge. So you now have lower income, but higher taxes in the same year. Today, I'm going to show you why that happens, exactly what it costs over a lifetime, and the plan that turns what would be a six-figure tax problem into a much, much smaller one. But before I continue, I want to make sure that you know Oak Capital Advisors, my firm, is currently accepting new clients the end of July. So if you are a CRNA or a nurse practitioner looking for a financial plan that is built around your income, your accounts, and your timeline, you can schedule a free introductory call through the link in the show notes, or you can directly do so at connectwithbrett.com. So I'm going to walk you through a household that I work with because it fits this topic perfectly. Now, I've naturally changed the names, but the numbers here are real. Diane is 62. She's a CRNA at a Charleston hospital system, and she has 28 years in, and she plans to work until she's 65. She has $2 million saved in her 403b, and she has a rollover IRA. She also has a small Roth that she opened in her late 40s. Her Social Security benefit will be about $2,700 a month at her full retirement age. Diane's husband is Paul. He's 66 and a retired high school teacher. So he has a state pension, and he elected single life. Now that means it only pays while he's alive, and he decided this years ago before they really fully understood what that election meant for Diane. Paul also has $400,000 in a traditional IRA, and his Social Security is actually larger. It's about $3,600 a month. And Paul has a very serious heart condition, which they, of course, are aware of. Now, while both of them are alive, the picture looks fine. They have the two Social Security checks, they have Paul's pension, and of course they have Diane's salary while she finishes her career. So the plan for them is currently working. There is no issue. And when Diane came in for what she thought was a routine progress meeting, she had a question about her Roth account, and it was almost as an afterthought. But the financial number that mattered actually wasn't in her question. And when we ran this scenario, her survivor's tax bill was roughly, now wait for it, $13,000 a year higher than their current tax bill on lower income. And then as we played things out over the future years Diane would spend as this proverbial single filer, the total cost came to around $180,000. Now here's the kicker. Almost all of this $180,000 is avoidable, but only from where they are sitting today, while both of them are alive and still here. So here's what's happening to Diane's taxes the year after Paul dies, and why it's the opposite of what most people actually expect to happen. So a lot of couples build a retirement plan that works beautifully for two people. They map out the income over the years. They have their withdrawals coming from their retirement accounts, and they pay their taxes, and it all fits beautiful. But the plan quietly assumes that both names stay on the tax return. But the year that one spouse dies, the survivor naturally has to file as a single filer on their tax return. And that plan that fits so perfectly just the year before now produces a higher tax bill on lower income. And think about it, for a long-time married couple, it is almost close to certain that one of them will file as a single eventually, right? About 75% of married women become widows. Women outlive their husbands by 12 to 13 years on average. And in the CRNA profession, where the majority of practitioners are women, well, the nurse is often the one left behind. Now, the hard part about all of this isn't the mechanics. It's that the couple did everything right. Again, they ran their plan and they hit their targets. And yet, the plan still left the survivor exposed because it was built for two people, and now one of them is gone. So, in this example, when Paul dies, 3 of their income lines will change and one will not. Now, Diane, she gets to keep the larger of the 2 Social Security checks, and this would be Paul's at $3,600 a month. So she loses her own $2,700 a month. And I want to be clear, that $2,700 is gone for good. So if you think about it, that's about $32,000 a year now gone from the household. Then let's talk about Paul's pension. Remember that I said he chose a single life benefit. So that pension stops the day he dies. And without that income too, well, now the household income drops pretty hard. Paul's $400,000 IRA can roll into an IRA for Diane. That's easy. But now Diane's sitting on roughly $2.6 million, all of it in pre-tax money. And that sits on one withdrawal schedule. Now, what do I mean by that? I mean, at age 73, there is the required minimum distribution. That is the withdrawal the IRS forces you to take from pre-tax accounts starting at age 73. So now for Diane on $2.6 million, that's about $98,000 a year. So she has to pay tax on that amount. Whether there are 2 people in the house or 1, it does not matter. So if you stop and think about it, Diane's guaranteed income fell from loss of Social Security and the pension. But the forced withdrawal amount required from the pre-tax retirement accounts did not change. And so here's where things start to get complicated for Diane. Again, the year after Paul dies, she files her tax return as a single filer. Here, on her tax return, 2 things for her will shrink at once. First, her standard deduction drops from about $35,500 for a couple, both over age 65, to about $18,150 for a single filer over 65. So pretty much close to half of the amount. Next, her tax brackets actually compress. So as a couple, the 22% bracket did not start until $106,000 of taxable income. While filing single, it starts at about $50,000. So more of Diane's same income now gets taxed at 22% and 24% instead of 12%. On roughly $135,000 of income, her federal tax as a single filer is about $20,000. That same income on a joint return would have been about $9,900. So that's roughly $10,000 a year more in federal tax on income that went down, not up. And there's one more piece stacked on top of that. And this shows up in a place that a lot of people do not notice until 2 years after the funeral. And that is Medicare. Medicare charges higher earners what's called a surcharge on top of the standard premium amounts. And this is called IRMAA, the income surcharge that's added to Medicare premiums. And in 2026, that surcharge starts at $218,000 of income for a couple. But for a single filer, it starts at $109,000, so exactly half. As a married filing jointly couple, Diane and Paul's $135,000 of income was, of course, nowhere near the $218,000 threshold. So they paid nothing extra for Medicare. But the year that Diane files single, that same $135,000 is over the $109,000 single threshold. So guess what? She now pays an IRMAA surcharge, and that's roughly $1,100 a year in higher Medicare premiums. And because IRMAA runs on a 2-year look back, that surcharge shows up 2 years after the income year, so 2 years after Paul died. Well, by that point, many people have no idea why in the world their Medicare premiums went up. So let's now add all of this up for Diane. She has about $10,000 a year in extra federal tax. She has about $1,100 in IRMAA, and she has about $1,700 in South Carolina income tax on roughly the exact same amount that she and Paul had together as income. So let's round it. Let's call it $13,000 a year more. Well, over a 15-year survivor horizon, that's roughly $180,000. So she has the same required forced withdrawals from required minimum distributions. She has lower income, yet $180,000 more in taxes and Medicare premiums, simply because the tax return now became single filer. Again, 3 things happened to Diane. 1, her income fell. 2, her tax brackets and deductions shrank. And 3, her Medicare surcharge, which she never paid before, turned itself on 2 years after Paul's death. Now, some smart people argue that this problem is actually overstated. The idea, of course, is that when a spouse dies, your expenses will naturally fall. So the survivor, in theory, ends up about as well off as before. And for a household that's living off of just Social Security, that's 100% a fair point. All of the groceries or a second car, the extra insurance, those costs definitely do fall off. So let's give that to Diane. Let's say her expenses fall off by $15,000 to $20,000 a year when Paul passes. Well, remember, her tax and IRMAA penalty is $13,000 a year. Her forced RMD withdrawal is $98,000. And remember, there's no way to turn that thing off. So the day-to-day expense drop off by losing Paul, well, that doesn't really add up to much. So Diane doesn't need an explanation of the widow's penalty. She needs to protect the survivor. And she needs to do it while there are still 2 of them to act on it. Whenever a couple treats the plan as finished because it works for two people, the surviving spouse inherits the full forced income problem on a single tax return with literally no time left to do anything about it. So by the time this penalty is visible to you, well, guess what? The cheapest tax brackets the household will ever see are now gone. But again, there is a window. And that's while both spouses are alive and both retired and before required minimum distributions start. Because the household sits in the lowest of tax brackets it will ever see again. The married filing jointly tax brackets are wider. The standard deduction is larger. And the income is low because neither person is yet pulling out their RMDs. So I believe there are three variables that determine how wide that window is or that runway and how much you can do with it. First off, the years while both are alive and both retired before RMDs start. That's the window I'm talking about. That's your runway. So it opens when the lower earner stops working, and then it closes on the first death or when RMDs kick in, whichever comes first. Second is the pre-tax balance in retirement accounts. So this is easy. The bigger the pre-tax 403b, 401k, IRA, whatever, the bigger the forced withdrawal the survivor inherits, right? And the more there is to move while the tax brackets are wide. And third is Social Security and pension elections. So the surviving spouse keeps the larger of the two Social Security benefits, always. So whose benefit is larger and when it is claimed, in essence, sets the survivor's income floor. And likely with a pension, the single life election just quietly amplifies the problem the way Paul's did for Diane. Because remember, she just loses that income when he dies. And I like to call the plan that uses all three of these variables together the survivor's window. It is a multi-year plan that uses the low tax bracket years while both spouses are alive to move pre-tax money to Roth, maximize the survivor's guaranteed income, and clean up the elections if it's possible. So this way, the surviving spouse inherits a smaller required minimum distribution, which means a smaller tax base, and then stays under the brackets and Medicare cliffs that created this penalty in the first place. So move number one is we fill the joint brackets with Roth conversions. And again, we do this while Diane and Paul are both retired and before required minimum distributions start because their taxable income is low. Therefore, there is room for us at the top of the 12% and 22% joint brackets. So each year, we can fit in money by converting enough pre-tax money to Roth to fill up that room at joint rates. And for Diane and Paul, that's moving about $800,000 pre-tax to Roth from ages 63 to 72 for about a 10-year window. And every dollar we're able to convert is a dollar that never, ever generates a required minimum distribution and never counts towards the survivor's Medicare thresholds. Oh, and by the way, it never gets taxed in the compressed single brackets later. And the second move is we set the survivor's income floor. So ideally, we would like to delay the higher earner's Social Security toward age 70, because this way the survivor keeps the larger of the two checks for the rest of her life. In this instance, every dollar added to Paul's benefit is a dollar that Diane gets to keep permanently. And if possible, revisit that pension election. If Paul's election can still be changed to a joint and survivor option, well, that replaces income Diane would otherwise lose. And if it can't, well, then the Roth that they are building can stand in for it. And move number 3, we want to make sure the accounts pass cleanly. Now, this is a small thing, but it's critical. Confirming that Diane is named correctly so that Paul's IRA rolls directly into her own IRA. Believe me, I have seen this. A botched beneficiary designation that can force a 10-year drain down of an entire retirement account that just stacks even more taxable income onto a single filer's return in the worst possible years. And once Diane is over 73 and taking RMDs, we will often look to route some of that directly to charity as a qualified charitable distribution, because this satisfies the RMD amount without adding a dollar to her income or her Medicare thresholds. So for Diane, when I ran the numbers with the survivor's window in place, this is how things changed for her. From ages 63 to 72, Diane and Paul would convert about $800,000 to Roth at married filing jointly tax rates. So the pre-tax retirement balance drops from roughly $2.6 million to about $1.8 million. Then, when Diane is alone at 73, her required minimum distribution naturally drops to $68,000, not $98,000. And therefore, her income as a single tax filer falls to about $105,000. And guess what? That keeps her under the $109,000 Medicare surcharge threshold, as well as out of the 24% tax bracket entirely. And by this point, with all the conversions, the Roth account is pretty sizable. So this is money that she draws on without adding anything to her taxable income. So remember that roughly $13,000 a year penalty that I mentioned in the beginning. Well, now it shrinks to just a few $1,000s. And that $180,000 lifetime cost falls to just a fraction of it. Now, in the scenario, the death obviously is still a loss, but it's no longer a tax event that she walks into blind. So here's what I want you to take from this. The survivor's penalty is lower income and a higher tax rate in the same year. And the forced required minimum distribution, this does not shrink when the tax brackets and the standard deduction does. So this is one of the few expensive events in retirement that you can actually see coming years in advance, which therefore means it's one of the few things that you can actually plan around. But again, the window to do something about it is only open while both spouses are still alive, because the tax brackets that you have together are the cheapest you will ever see. Trust me. And if you've already watched our episodes on Roth conversions, this is the reason that work matters, even more than you thought. Because the conversion calendar and the survivor's window are the same planning machinery that are pointed at the exact same deadline. So if you want to see what the survivor's window looks like for your household with your account balances and your numbers, schedule a call with me at connectwithbrett.com. I'm Brett Fellows. Take care of yourself and take care of your money.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.